Good afternoon. My name is Quinn Zhang, and I'm a first-year full-time MBA student. And this is Junyi Huang, a senior at UCLA majoring in economics. We are co-directors of today's panel discussion, focused on the importance of cross-border M&A, opportunities for China and the United States. Chinese companies have evolved as an important driver of global deal-making in the past decade. Over the last couple of years, overseas mergers and acquisitions by Chinese companies have been the highlight of the global M&A market and are poised to increase. Important shifts have been witnessed in the mix of sectors, investors, and policy developments that are shaping China-US direct investment flows. Our panelists this afternoon will address China's foreign investment patterns and strategies, discuss how the US and China can both benefit from this investment and balance risk and return on both sides, and will share their predictions on future Chinese deal-making in the United States. We are delighted to welcome our moderator for this panel, Alan Wang. Thank you.
Thank you. We've got a great panel today. So my name is Alan Wang. I'm a partner in the Boston office of Latham & Watkins. Latham & Watkins is the largest law firm in the world by revenues, for those of you who don't know. I just came back to the United States after serving for 5 or 6 years as the office managing partner of the firm's office in Beijing. So I do mergers and acquisitions and capital markets transactions involving Chinese companies. So maybe I could allow the panelists to talk for themselves. Lisa, do you want to introduce yourself?
Sure. I'm Lisa Chen. I've been with Aon for 20 years. Part of that 20 years, I was sitting in Shanghai as the deputy GM, helped to run Aon China. That's from 2008 and 2012. Came back and giving the initiative driver position to drive Chinese business practice for the company in the US. Aon, as you may know, is a world-leading company, leader basically in our field, which is the risk management, insurance consulting, broking. So we have been providing consulting services from human capital to risk-related property or insurance, property insurance or casualty liability related insurance as well. So today is a very much of a pleasure to be here, to be part of this distinguished panelist. Thank you so much.
Great, please. Seamus?
Yeah, my name is Seamus. I grew up not in Dublin, but in Shanghai. So part of PwC's deals practice, and for those who don't know, PwC has a deals practice. We are not only an accounting firm or tax firm, but also we have a big consulting practice, which includes management consulting, which we recently acquired Booz Allen. Also, we have the largest deals due diligence practice in the world. We also have a middle market corporate banking, as well as integration services, post-deal integration services. So personally, I grew up in Shanghai. I spent 25 years there. Came to the States about, hard to believe, it was 13 years ago. And went to Emory for MBA because UCLA is not taking my application. So, I try to avoid that history. But so after graduation from Emory, I joined transaction services, now the deals practice in Philadelphia. So I currently lead the China-US cross-border deals practice, and have been spending 3 to 4 years focusing, helping Chinese investors looking at US operations and assets.
Excellent, great. Cavan?
Hi, Cavan Yang, like Seamus, 100% Irish, as our names indicate. I'm an ABC, so I born here, grew up here, actually grew up in Newport Beach. After undergrad, I became an investment banker focused on M&A and have been doing that ever since. So for the last 15 or so years, I have been with Merril Lynch for 11 years now.
Great. I think it's a great panel. So let's just get into it. So, as Chinese firms are diversifying overseas, what do the panelists think that the main focus of these companies will be over the next 12 months, 2 years, 5 years? What sectors are going to be hot? Cavan, do you have a view?
No. I think, so in full disclosure, I cover real estate, gaming, and lodging for my firm, and just M&A specifically. So I obviously have a bias towards those sectors, but putting real estate aside, which will always be, in my mind, pretty strong from an M&A perspective, in my opinion, Chinese outbound M&A has been driven historically by industrial products and durable goods. This was a lot of the result of Chinese government spending a lot in public infrastructure, similar to what FDR was doing in the New Deal. So spending a lot on how public works are shaped, putting a lot of capital in that. What resulted was a consistent period over the last 3 decades of 8 to 10% growth every single year. And so it was like basically a bellwether economy, never really vacillating. Now you've gotten to the size where that 8 to 10% growth isn't achievable any longer, and you've moved from an economy that's become historically a net producer and exporter to an economy that's become more of a net consumer. And so what we're seeing is a shift in corporate patterns, and in the history of inorganic growth, which is M&A activity has typically followed wherever that corporate growth is. And most recently, that's been in technology, telecom, and consumer products. So recently, you've seen a lot more M&A activity, especially from Chinese companies in technology, consumer, and telecom products. So while that kind of covers historically, what do I think will happen? I think the future for all M&A and for Chinese companies really in services companies. I think there's going to be a lot more M&A activity in service-related companies. If I asked everyone in the room, what do you think of a company like Facebook, Uber, Alibaba, Amazon, Netflix? What kind of companies are those? Most people would say they're tech companies. I take a different view. I don't view them as tech companies. I view them as service companies that just have a enviable technology-enabled platform. So they're based on a good technology foundation. So, what does that mean for M&A overall? I think it means that people are going to gradually shift towards more service-oriented companies and have a greater amount of M&A activity in services-oriented companies, especially as Chinese companies continue to invest more money overseas. It's not going to be as much in the industrial products, the durable goods, and telecommunications and technology. That will still drive M&A activity, but I think M&A activity will be driven by services companies going forward.
Anybody else any thoughts on that?
Yeah, I can't agree more with Cavan's view. I think you covered it all from a historical standpoint, and I just want to add a few on the outlook. What we're seeing is there's definitely a transformation of Chinese economy ongoing. There's a huge middle class group now, which is rich enough to upgrade their consumption. So they are not, satisfied with basic stuff, and they are looking for more soft content, entertainment, sports, spiritual consumption, sort of. So you'll see, I think Mr. Harrington talked about the Wang Jianling's view, right? He's buying sports, he's buying media companies, he's trying to be the Disney in China, right? He's building studios, building theme parks in China, and he has invested in tourism group in China as well. So with all that, you can see there's a huge trend pushing towards that, buying content, buying soft, brand IP in this type of sectors.
That's interesting. You're talking about innovation and technology. I don't know, is China increasing its footprint in terms of innovation in the global marketplace? Lisa, do you have any view about that?
Well, I wouldn't say that China is increasing innovation. I think by footprint, by acquiring companies, but rather to leverage the technology at the global stage and to have sort of the reverse effect. We have seen companies who come in to whether it's acquiring a new company, it's already existing company or a greenfield project. It's all targeted to what they could leverage out of whether it's technology, as what Seamus and Cavan just said, but also how about utilizing the marketing power, the market power in China? In case, one perfect example, Yuhuang Chemical, who just started a brand new greenfield project. It's huge. It's in Louisiana. What they're doing is they're building a methanol plant, but most of the outcome of that production is going to be imported or exported into China. So because of that, I think the leverage of both markets, technology and innovation. Innovation, in my view, from the service sector, is for sure a growing sector. Even from our own industry, insurance industry, for instance, insurance broking services. In the past, it was never viewed as valuable, professional services. Now it's all part of the deal making. In order to succeed, win a deal, that's one. Another thing is the value-added services that has been shown, has been highly appreciated by the client. So that type of industry also driving insurance company purchases, right? Acquisitions in the U.S. That is, for instance, Fosun's Ironshore. That's a good example. And also in-house insurance broking. This is sort of the new trend. Every large corporation will have their in-house brokers in China now. So this is sort of what I think is also on the rise. Yeah.
Trends in insurance. Well, how about this recent? We talked about secular long-term trends. How about this recent market turbulence? We've seen stock market go down, stock market go up. We've seen a decrease in deal activity. I don't know if you guys think. You're a banker, Cavan. What do you think about that? How is the market turbulence affecting deal making between China and the U.S.?
I think it's a good question because as an M&A practitioner, volatility is directly inversely correlated with M&A activity. So anytime you experience a huge period of volatility, you're not going to see a lot of M&A activity. And you saw that in the most recent quarter, in Q1 2016. I think on a US basis, we were down 30 or 35% over Q1 2015. That's a huge drop. You don't see M&A activity drop that much unless you're in a prolonged recessionary period, which we're not today. So ultimately, what does that mean? Well, when you look at Chinese M&A activity, there was, I think, like $30 billion or so of inbound Chinese M&A activity with US companies. But you compare that over the 24-month period prior, and it's probably the same amount. So over a 3-month period, you have as much volume as you did over a 24-month period. You had deals like Blackstone buying strategic hotels, but then selling it immediately to Anbang. You had Tianjin Tianhai buy Ingram Micro. So you had a lot of big deals out there that were getting driven by a whole host of different factors, including an abundance of capital. And so while U.S. and global M&A activity was significantly down, Chinese M&A activity was up. What that data trend indicates to me is that on a day-to-day basis, Chinese buyers are becoming more aggressive. They're seeing that, look, in a volatile market, I may be a buyer of last resort because when in full disclosure, I don't advise Chinese companies. I do, my focus is really running the M&A practice for real estate, gaming, and lodging companies in the U.S. So we deal with Chinese companies, not as buyers. We don't advise them as often because Chinese buyers tend not to hire investment banks especially U.S. investment banks, as their advisors. So on the sell side, when I'm looking at deals, I'm often going to strategic buyers and saying, well, can we do a stock-for-stock deal? Can you pay a premium for us? And in a period of market volatility, a lot of the clients I interact with aren't going to want to do deals. On the flip side, when you go to a Chinese buyer, they're not as focused on short-term market dynamics. Surprisingly, they're much more long-term focused, just like a lot of other foreign buyers are. So US CEOs, they're focused on a quarter-by-quarter basis. So they have to answer to Wall Street, they have to answer to their investors on a quarter-by-quarter basis and say, okay, why did you do this big deal in the face of a stock market that was going to drop 30%? Private equity has a very short-term focus as well, even though it's a little longer than public companies, 3 to 7 years. So they have to go back to their investors and say, well, we were at the precipice of a market, similar to 2008, and we couldn't see the bottom. Why did you go out and make a big deal for a company like Strategic Hotels or a company like Ingram Micro? And when you have to answer to that, it's a lot harder to go transact. On the flip side, a Chinese buyer, there's a lot less transparency as to what motivates them to buy companies, but I think it's a much more longer-term focus on investing in the U.S. and trying to ride the upside wave over a longer period of time.
That's really interesting. I know. Does anybody else have a view on that?
Yeah, I think it's just talking about the long-term view from Chinese investors, I think they definitely not focus on quarter by quarter, right, as the U.S. public companies. And a lot of Chinese companies actually looking at this target for a long, long time, right, such as Ingram Macro and such as Lexmark, which just was announced to sell to an unknown Chinese company with 2 PE co-investors. Even an unknown Chinese company to me, which I deal with Chinese company all the time, but it's an Asia-listed company, and it has capital and has 2, Legend Capital is one of the co-investor who is backed by Legend Group. So they have been looking at the Lexmark for a long, long time, and there's 3 rumors in October. I think they were looking at it, and the market volatility kind of gave them the chances to just come in and announce the deal. So that's kind of come back to Cavan is saying is they take a long-term view and kind of look at a company and jump on opportunities when there's volatility.
That's great. Well, let's switch to a different topic. Let's talk about real estate. We've seen in our firm an increase in interest in U.S. real estate assets from Chinese buyers. Chinese people love to gamble, and they love real estate too. You know that, Cavan. Do we think that this is going to be a large driver of growth in M&A in the future? Lisa, you have
Well,
on that?
I personally think so. Just because real estate, real properties are familiar targets for Chinese. Honestly, most of the Chinese wealth probably originated from real estate, right? Investments. So, and also, as you know, you heard of EB-5. EB-5 is sort of an immigration visa that U.S. gave out to attract additional investments into the U.S. So Chinese have been probably the majority user of that tool or channel to gain green card. So EB-5 is continue going to be the driver for real estate investment in the U.S. because the investors understand properties. The investors say, if I invest $500,000 or $1 million, at least I can see something. I brick and mortars, and we own something. If the economy is not good, real estate is still pretty okay. So that's why in terms of location, they're going to be continuously focused in the coastal areas, which has we say real estate location, and location. So wherever the location is going to drive the potential growth, the real estate projects or real estate investment will continue. So I'm not a real estate expert. I'm sure later you can hear from that real estate panel. But meanwhile, I think market leverage as well. A lot of the developers we're working with, they build condos, they build real estate projects here, but really they are leveraging the market power back home in China to sell those condos and to generate initial, investment returns. So that is also very safe, So I think we'll continue.
Anybody else have any views on real estate?
Yeah, I think.
Do it?
Look, like real estate's attractive because you deal with 2 factors. You deal with yield, which is just basically a coupon, and you deal with price appreciation. You deal with price appreciation on the underlying asset. And generally speaking, real estate, to Lisa's point, is a very, very safe investment. I think what hopefully everyone heard, Lisa's key point is coastal. I think Chinese investors, you're not going to see Chinese investors invest in Little Rock or Omaha and in multifamily assets or single-family homes. You're going to see Chinese and other foreign investors, for the most part, across the board, invest in gateway markets. New York, San Fran, Boston, Chicago. You'll want to. These are the types of investments that are attractive, mainly because they're easy to get to. To go to Wichita, if you were going to come from Beijing, you probably have to take two transfers. But to go to LA or to San Fran, it's a direct flight. So if you have an asset that is available in a gateway market, you'll continue to see foreign interest in acquiring that asset.
Right.
It's amazing.
And Los Angeles is the best location. So
it was
it's great
top on
for
the
you.
chart, right?
UCLA,
Yeah.
Los Angeles is a top destination for U.S.
Absolutely.
For Chinese people.
Absolutely, will continue to be.
I grew up in Boston, and I was the only Chinese person there growing up, and it's all Chinese people there. And I can't. Anyway, let's talk about something else. We'd all worked with state-owned enterprises, and that it's kind of tiring. That has its challenges. But we've seen recently that state-owned enterprises have had their challenges in terms of anti-corruption and capital constraints. do people on the panel think that this is going to impact M&A activity going forward? Seamus, do you have a view? You've worked with these
Yeah,
the
sure.
SOEs before.
Sure, yeah. Certainly there's impact. When I started to deal with China inbound clients about 5-6 years ago, it was all big SOEs looking for energy, oil, resource type of deals, and chemical deals. Then I think in recent years you'll see that they stop coming or they were not successful. Even they come and to negotiate a deal, partially because domestically they are facing, like I said, the corruption scheme there, and SOE bosses are very careful and they'll be very cautious about their career. That's why they don't really want to take a lot of risks. However, on the flip side, I would say overall the activity goes up so tremendously for the private sector, so it's kind of overshadowed the SOE investment. It's not really the SOE investment declining rapidly, it's kind of stable and declining maybe slowly, but the private investment outpaced SOE sector in such a tremendous way. And the headline news is all about Outbound, about HNA, Hainan Airlines, and about these Fosun is buying insurance companies. So you hear that a lot more. So that's my view.
Well, you talked about something, the Outbound, that deal, that was all over the papers. Is this reflective of a trend about?
Yeah, I think that one, everybody knows the Star Wars one. It was so dramatic, right? Outbound raised the price for twice and abruptly withdraw their bid. I think there's a couple of things behind it. One is going back to real estate, right? Although it's a hospitality play, it's mostly driven by the brand of Star Wars and underlying the properties and the yield coming out of that licensing. The Star Wars is a brand company. It's not they are not even a hotel management company. They are just a branding company. They charge royalties on the brand. So it's a yield play at the end of the day. What like insurance company like Outbound is looking is they have tremendous power to get policies underwritten in China, pulling the premium in, but they have to invest that money. And they want to diversify currency risk, right? Everybody expecting, there's a depreciation of RMB coming. So they are in a rush to diversify the portfolio. That applies to a lot of insurance companies in China, actually. So they go out finding yield, right? They go to real estate, they go to hotels, they go to these assets that provide them are relatively safe yield, and they have a lot of capital to deploy. So that's kind of driving that, kind of a trend.
It's all about insurance companies.
Right. Also,
Yeah,
I think
it's
also, Starwood is a trophy brand,
Yeah,
as you said.
it is.
This is we won't blame Outbound, right, for trying, but this trophy brand is not there all the time, available for sale. So you will see this type of competitive situation coming up, hostile takeover sort of offers, I'm sure, in the future.
Mm-hmm.
So you talked about banking terms. One thing we always talk about is synergies, and that's one of the things that drives mergers. For instance, in the U.S., you have two companies. You can remove some of the costs. You can create synergies. But for a Chinese company and a U.S. company, are there synergies in deals? I don't know. Somebody has a view?
Not really. I mean, if you look honestly, if you're a company that has no infrastructure in the U.S., good example is Lenovo was a client back in 2005 when they went to buy IBM's PC business. They had no U.S. infrastructure. They had nothing in the U.S. So when they came over and bought IBM's PC business, they had to start from scratch. So there's no really quote-unquote cost synergies where you could go in and eliminate 1,000 heads. When we sold them the x86 server business 2 years ago, which was a deal I worked on, we came in and we were able to tell them, hey, there's a $300 million synergy play here, because you have the infrastructure in the U.S. today. In 2005, Lenovo was, no one knew who Lenovo was. Now they're a pure brand name. So I think, Alan, to your point, there are synergies today if there's infrastructure. I'm just looking from a pure financial and mathematical point of view, but I think historically there hasn't been when a company doesn't have the necessary infrastructure in the U.S.
Yeah, I'll look at synergy differently. It's I think traditionally the definition of synergy is kind of say you have X dollar to save because you can consolidate infrastructure, or you have cross-selling opportunities on the top line, etc. Yeah, for that, Chinese company tend to lack, right? And integration is not typically a play, we wish it's a play, right? So we are very big in the merger integration practice, and that's the big money to be made. However, every deal we've done, and we'll come back to the Chinese client, say, we have this tremendous integration capability. Do you want it? They say no. My plan is keep it as is. I'm not touching it even. I want to retain the management and let them to continue to run the business. I will be more our passive investor. But looking at the other way, they wanted the brand coming back to China or leverage whatever the expertise here or IP and bring that back to China to increase their barrier of entry or competitive advantage in the domestic market. So it's kind of different than typical people thinking about why they're doing this deal. They are not touching it. They are not making any changes in the U.S. Where's the value? The value is in the long run. They want to be, kind of the market leader in China. So.
Well, related to synergies is after you do a deal is when you integrate the two companies post-merger. Does anybody have any experience with that, the difficulties of post-merger integration?
Well, I'll add to your point.
Yeah.
After Chinese acquires a company, I think there are going to be two elements in terms of integration. One is more about management level integration. Another area is very critical, is a functional area integration. Management, we have seen different treatment of investors from China. Some companies just leave, our client will leave the company alone. Okay, so we're not touching that. We're sending a CEO, a CFO, perhaps even hire local CFO, but accountant, I'll be alongside, and then let them run. And that's one. Another's, most from private sectors would say, okay, I don't like this, CEO. Why do you want to fire him? Because I don't like him. He's not in my, not the same wavelength. Oh, okay. So how are you going to fire him? Oh, so this is the part of the issues that we're facing that you are, Seamus is saying, we have this integration, especially from the people side. We need to integrate them from culture perspective, operational, styles, business styles. But they, once you wanted to fire somebody, that's fine, but you need to fire them the right way. So you're not getting sued. You're not paying out so much before you're even starting making a penny, on this company. So that is one thing. And the functional, this is very critical too, finance functions. We see companies couldn't even get the IT platform integrated because in China, especially state-owned enterprises, including ourselves, we have a joint venture in China. Then the cloud, it's only China cloud. You cannot, whether it's clear or polluted, it's China cloud. You cannot go outside of China because it's for security reasons. So therefore, how are you going to connect? This is technology age, right? You got to integrate the data, and that is a huge issue. So, and then of course, HR. The talent issue in China is different than here. And integration of talents, integration of talent practice in the US is very much of a key because we see companies come in, buy the company, but then worry about how we're going to attract talent, right? And also compensation, exactly compensation. So all of this all going to be the key issues, yeah.
Those are huge
Challenges.
issues, huge challenges, yeah. How about something that I hear a lot about is CFIUS, right? So CFIUS is the U.S. organization that can block a transaction from a foreign buyer if it threatens the national security interests of the United States. We saw this come up like 10 years ago when there was a bid for Unical in California, and I was wondering if anybody had any thoughts on that. What is the CFIUS risk for PRC companies?
I think does everyone know what CFIUS is? It's a committee for foreign investment in the U.S. It's a governing body, like the SEC kind of, that basically rules on whether or not a deal is in the best interest of national security or has negative consequences to our national security. So for instance, they became really big when Dubai World tried to buy the ports in Newark and New Jersey, the Port Authority there. And it was back in 2006 under the Bush administration. That got blocked, and a couple other deals by Middle Easterns got blocked in the wake of 9/11 because people were worried about Middle Easterns owning strategically important assets in the US. So CFIUS is always going to be a risk. And as an M&A practitioner, when I advise clients, I kind of stress three things. One thing is price, second thing is speed, and third thing is certainty, not in that order. But price is always a big issue in M&A deals. You always want to get the best price. Chinese buyers have that box checked big time. Anytime we run a process, we say, call Chinese buyers because they'll pay the big price and they'll pay a stupid premium. Because they'll want the asset. Speed, Seamus hit on this earlier. Chinese buyers take a very, very long-term focus. They also take a lot of time going through their M&A process. Onbong's a great example. They got called, based on public disclosure, they got called back in the summer when Citi and Lazard were running their process for Starwood, just like everyone else got called, like Merril got called last summer. And it took them almost a year to put in an actual proposal. They could have avoided all the drama by putting in a proposal, running the process, and then finding out they couldn't do it. But they invited a lot of drama by doing so. So speed is an issue for Chinese buyers. Getting back to Alan's question, CFIUS is going to continue to be an issue for Chinese buyers because it's a lack of certainty. If I'm a seller and I deal with the US government and a Chinese buyer comes in and says, hey, we want to buy you for a great premium, my concern is always going to be certainty. Can this Chinese buyer get it done? What can they do in order to prevent the government from blocking the deal? Fairchild Semiconductor, great bellwether company in the US, long-standing company in Silicon Valley. They had a deal signed up with OnSemi. Hua Capital and China Resources came in and did the same thing Onbong did. They outbid OnSemi and said, we're going to pay you an additional $300 million on top of a $2.5 billion deal or so. And Fairchild took a look at it and said, you know what, we're not comfortable with taking the risk of going with a Chinese buyer who has no transparency in who owns the company. Because with a US company, you can say, my public investors are Fidelity and Vanguard, and you know who all the investors are and you know who runs the company. With a Chinese company, you don't know if they're run by or owned by public investors, or you don't know if they're run by the Chinese government. So that adds a degree of uncertainty to it where you don't know if CFIUS is going to come in and block the deal for you. And there's another deal going on right now in real time. Terex, which is a crane manufacturer, which has priority rated contracts with the US government, signed up a deal with Konecranes, a European company. That deal will likely get done. But this company, Zoomlion in China, came in and put in a topping bid. Again, similar to Fairchild and similar to the Onbong transaction. And right now, Terex have put the brakes on the process. They said, look, okay, we have a deal in the market, but we want to evaluate whether or not the Zoomlion deal is better value for our shareholders. But what they're struggling with is the fact that CFIUS is likely going to come in and say, you can't do this deal. So they're trying to figure out, well, how do I weigh price versus certainty? And with price being higher and certainty being lower, is there a way to evaluate deals?
Right. I will add to Kevin's point of the Fairchild deal. Okay, this is I happen to have some personal experience with that deal. The reason is CFIUS risk become really real is because not only the U.S. sellers are worried, but also Chinese buyers are quite concerned as well. More and more we've seen, including Hainan Airlines, who have put in a bid for the Ingram Micro. In order to even win the bid to move forward, to get the deal in front of CFIUS, you have to commit to the seller in case CFIUS does not prove the deal. So there's going to be a reverse breakup fee. The reverse breakup fee started lower and now it's very high. For certain deals, there's a Hainan, this is public, Hainan Airline deal, they committed $400 million. If this is it's been blocked, Hainan Airlines have to come up with that. So therefore, I think it's a measure from both ends whether this risk is worth taking. If so, what about transferring that risk?
Yeah, the M&A market is amazing. It just transforms itself, because of the demand of different buyers coming to the market and different needs, and so it's amazing.
Yeah. Okay, so we should probably wrap it up with the last question. What do people think about the future deal making involving Chinese buyers and the United States. Cavan?
Sure. I think that Outbound didn't help the situation when they basically just pulled out. So it was very, very public, front page of the Wall Street Journal. I'd say when that first offer came in, I had a lot of clients who I'm running processes right now say, well, let's call all the Chinese buyers. Let's see if they can come and get involved in these processes, whereas they wouldn't before. I think a month later they said, wait, so there's all this uncertainty around Chinese buyers being able to close a transaction. Well, maybe we shouldn't call them. I think that's like a hiccup. I think generally speaking, Chinese buyers will take a new level of prominence year after year in M&A, in U.S. M&A deal making. I think that they're going to continue to want, for the reasons that Seamus talked about, devaluing currency, decelerating growth, need to expand globally. There are a lot of drivers for Chinese buyers wanting to come into the U.S. and buy U.S. assets that will continue to make them an attractive source of capital for U.S. companies.
Seamus?
Yeah, I'll say it's, in my view, it's a go, go, go. You know, important things you have to say 3 times, right? So, you know, I definitely think it's going to keep going very strong in the near future. Like Cavan said, all these macro, economic drivers are there, and just from a seller standpoint, I think U.S. sellers, started to accept Chinese buyers are legitimate buyers. The first deal, like we worked on a couple of big, like Wanda's deal. We helped them to buy the armament triathlon business. When that happens, the PE seller was very concerned. Even Wang Jian is the richest guy in China. They were very concerned whether the certainty of the deal. I mean, it was not cheap. It was like 900 million, including debt. So they were asked to put in a pretty big deposit to do that. But once he was able to demonstrate, they're a legitimate buyer, they're buying stuff, they'll be able to close the deal. The legendary deal came a lot easier, right? And a lot more is being cooked. I think the Outbound is not going to stop. So all these things, I think, is going to drive China inbound activities.
Right. To answer this question, I'd like to throw out a few numbers. So first of all, I'd like to ask everyone, do you know the total Chinese outbound investment in the US last year in US dollars? 15 billion. And the projection for this year is 30 billion. Now, whether it's going to materialize, I don't know. But there's also how many jobs US had, Chinese investment has created, 90,000. Okay, so 1,900 Chinese affiliated companies now, or with Chinese interest in the United States. So this is definitely is a trend. Should go up, but meanwhile there are risks to be considered associated with it because there are serious concerns with even the Foshan's Iron Shore acquisition. So Foshan, Iron Shore insurance companies. They live on ratings, okay? If there's bad rating, they're not going to get business. And their rating has been downgraded, not because Iron Shore is doing a bad job, it's because it's associated with Chinese investor. So that has been one of the risks. And also, economics, political risks. People who are the sellers will be afraid or be more concerned now about Chinese slowdown in economy, and perhaps political economic situation could spill out, or come through to the U.S. through acquisition. So these are all the risks to be considered and mitigated, but I think it's still on the rise.
Great.
Thank you.
I think that's it. All right. Thanks very much.
Thank you for coming.